Understanding investment funds, index, mutual, hedge, and ETF structures. 1. Introduction to investment funds. Investment funds are financial instruments that pool capital from multiple investors to collectively invest in a diversified portfolio of assets. This structure allows individual investors to gain access to a broader range of investment opportunities while minimizing the administrative burden and financial exposure of managing individual securities. Footnote: investment funds provide diversification and professional management by consolidating resources from multiple investors into a single pool. 2. Conceptual framework. What is a fund? A fund functions much like a communal pool of resources where contributors benefit from collective purchasing and management. For instance, akin to a group pooling funds to host a shared event, an investment fund aggregates capital to acquire financial assets such as stocks, bonds, or real estate. Each participant shares in the returns proportionally, while a fund manager or algorithm oversees allocation and risk. Footnote: the analogy of a communal event budget illustrates the collective investment and shared benefit structure of funds. 3. Index funds, passive market replication. Index funds are passively managed investment vehicles that aim to replicate the performance of a specific market index such as the S&P 500 or Nasdaq. They do not rely on predictive stock picking but instead mirror the holdings and proportions of the chosen index. This approach ensures low management fees, commonly between 0.02% and 0.20% annually, and broad market exposure. An important operational characteristic is that index fund trades are executed once daily, after the market closes, at the fund's net asset value, NAV. NAV is determined by dividing the total value of assets minus expenses by the number of outstanding shares. This delayed execution model contrasts with the real-time pricing of stocks or ETFs. Footnote: index funds replicate specific market indices to offer low-cost, diversified exposure without active management. 4. Mutual funds, active investment strategies. Mutual funds differ from index funds primarily in their management style. They are typically actively managed by professionals who aim to outperform benchmarks such as the S&P 500 by selecting securities based on strategic research. This approach results in significantly higher expense ratios, often ranging from 0.5% to 1.5% or more. Despite their higher fees, mutual funds may appeal to investors seeking specific market exposures or confidence in a fund manager's expertise. As with index funds, mutual fund orders are also executed at the end of day NAV. Providers such as Vanguard, Fidelity, and J.P. Morgan offer both actively and passively managed mutual fund options. Footnote: mutual funds are characterized by active management, higher fees, and strategic selection of investments aimed at outperforming market indices. 5. Hedge funds, high risk, high reward instruments. Hedge funds are private investment partnerships accessible only to accredited investors, typically with high net worth. These funds employ aggressive strategies including short selling, leverage, and derivatives to seek superior returns. The management model often involves a 2 and 20 fee structure, 2% annually on assets under management and 20% of generated profits. Hedge funds provide maximum flexibility to fund managers but expose investors to significant volatility and potential losses. Their exclusivity and complex risk profiles render them unsuitable for average retail investors. Footnote: hedge funds deploy high-risk strategies and exclusive fee models, targeting wealthy investors willing to embrace significant volatility. 6. Exchange-traded funds, ETFs, flexibility and liquidity. ETFs combine the diversification benefits of index funds with the liquidity of individual stocks. They trade throughout the day on stock exchanges, enabling investors to buy or sell shares in real time. Like index funds, many ETFs track specific indices but can also be designed to focus on sectors, commodities, or global markets. Fees for ETFs are generally low, ranging from 0.03% to 0.75%. Their popularity stems from intraday liquidity, real-time pricing, and accessibility through commission-free brokerage platforms. ETFs offer a practical balance between passive investing and market agility. Footnote: ETFs offer low-cost, diversified exposure to various markets with the advantage of real-time trading. 7. Conclusion: selecting the right fund for your investment goals. For most individual investors, index funds and ETFs provide the most practical entry points into the market. They are low-cost, easy to manage, and widely diversified. Mutual funds may suit those seeking specific strategies or sectors, despite higher fees. Hedge funds are generally reserved for high net worth individuals due to their elevated risk and expense. Understanding these distinctions empowers investors to align their financial goals with the appropriate investment vehicle, balancing cost, risk, and return potential. Footnote: aligning investment objectives with fund structure is essential for cost efficiency, diversification, and long-term success.